Welcome to Barchart's series of educational webinars designed to enlighten you about a variety of trading ideas and concepts. Today's session, Mastering the Art of Trading, Proven Strategies, Psychological Insights, and Expert Guidance. In this special session, we'll get an opportunity to hear from one of Barchart's most distinguished contributors as he reveals his 7 rules on markets and discover the depth and wisdom of his expertise that comes from these simple tenets. Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategist, and as I mentioned, today's session will be a departure from our regular sessions, as I get a chance to pick the brain of Darin Newsom, Barchart's Senior Market Analyst and trusted contributor. Now, in my career, it's not often I get to talk to someone who has been around as long as I have, but also someone whose experience and knowledge encompasses a wide range of markets. So stick around as I parlay with Mr. Darin Newsom. To help me out with today's session is someone who is an expert in her own right, Barchart's project director and our moderator, Jean Baker. Hello, Jean.
Hello there, John. How are you?
I'm doing very well. Welcome back. Thomas sat in for you last week, but I got to say, it was just not the same without you.
Oh, come on. Yeah, it was. Well, thanks for saying that. Hey, we're all really excited to have this special guest of yours here today. So I know you want to get into introductions, and I'm going to let you go ahead with that, okay?
All right, Jean, thanks so much.
Thanks.
Just a reminder that today's session is for educational purposes only, and decisions to buy, sell, hold, or trade any security or commodity or otherwise investments involves risk and best made by the advice of a qualified financial professional. And under no circumstances shall we be liable for any loss or damages anyone activities that you or anyone engages in based on information or material you receive through barchart.com and our services. Okay, without further ado, our special guest has actively been trading and analyzing markets for over 35 years, is an award-winning columnist, and as I said before, one of Barchart's favorite and trusted contributors. And he's been enlightening Barchart readers with his knowledge, expertise, and what I love about him, his wit. So please welcome Darin Newsom. Welcome, Darin.
Thank you, John. I really appreciate the opportunity to visit with you today.
I appreciate taking time to be part of our process. So I really want to thank you for that as well. So as I said in my opening, Darin, is that rarely do I meet someone who has been, around the block as many times as I have. And I believe also, you also know where all the good parking spots are. So I'm really looking forward to having a discussion with you today.
Yeah, this will be fun. This will be fun.
So Darin, just give us a kind of a brief run through of your career, but really what I want you to do also is give me a kind of an idea of your philosophy to trading, and then we'll move on to your 7 rules to markets.
Yeah, it's interesting, John. I've done a little bit of everything, most of it on the commodity side, but I say that, but I got into this business on Black Monday, or around the time of Black Monday 1987. I was actually working in a local grain elevator, and I just had this hunch that something big was going to happen in the S&P. Started doing some options, opened an account in our local office, started doing some options, and so and it's just kind of snowballed from there. Again, most of my what I've looked at over the years has been commodities, but to me it's been a process of figuring out. It's not always, and we'll get into this later, but it's not always trying to figure out why things did what they did. Nobody knows. But I'm more interested in what was happening. How do we explain it in the terms of what? That's what's really important. And so over the years, I've looked at all the technicals, I've looked at all the fundamentals, I've thrown 90% of it out. I've winnowed it down to these 7 rules plus, a number of other things that I talk about over the course of a day, week, month, so on. But it's my own combination of technical and fundamental analysis. With one of the rules that we'll talk about later, fundamentals win in the end.
I believe that as well. So I'm looking forward to getting there. So let's get right to the meat and the potatoes. All right. So your Darin Newsom's rules on market. So let's talk about rule number 1. So rule number 1 is don't get crossways with the trend. All right. So I'm going to let you just start off with this, but I think I have an idea what this is about.
Yeah, it's my take on Newton's first law of motion applied to markets. And that was one of the very first things I ever learned when I started teaching myself technical analysis is, trending market will stay in that trend until acted upon by an outside force. And that outside force is usually non-commercial fund, whatever you want to call it, money. And very few of us are big enough to stand in front of that. So don't get crossways with it. Just stay with the trend. And when I say trend, I'm not talking about all, again, I've thrown out most of the technical analysis I ever learned. It's just simply price direction over time. How are prices moving? And then, we can start to look for some very simple reversal patterns and these kinds of things, depending on the time frame. It's something that I always like to break down as well. There's a lot of day traders out there. There's folks that like to use daily charts, intraday charts, point and figure, weekly charts, monthly charts for longer term trades. One of the things that I developed is called the Goldilocks principle, where, and it fit my analysis, where daily charts are too hot, monthly charts were too cold, but weekly charts were just right. And for the folks that I was working with, that seemed to fit pretty well. Now, as I've gotten older and looking more at investments rather than just hedging and trading and these sorts of things, looking more at the monthly charts now as well. But it still comes down to simple, what's price direction over time, and stay with the trend as long as we can.
So what I've done is, you asked me for an example, is to pull up the corn price index. And what I've done here is I put up our grid. We have the monthly and the weekly chart. So again, in your process, you say that the monthly is a little bit too static, but certainly we can see the direction of price based on a monthly chart, and that you feel like the right time frame for market analysis is this weekly time frame, right?
Yeah, if I had a fund and if I had a corn fund that I was running, I would use this Barchart National Corn Price Index, the monthly chart, because what I'd be interested in on an investment would be the long-term trend. And as you said, we can clearly see that it's down. So if I'm looking at just being a long-only fund, I certainly wouldn't be jumping in yet, but we could be getting close. We're just not there yet. I wrote about it for Barchart here at the end of September, how we didn't quite get that reversal. But if I'm a hedger or if I'm a shorter term position, say an intermediate term position trader, then I would look over at the weekly chart and I can see here's where we get a little bit of a divergence, where we've got the possibility of a change in trend here. We've got some money possibly coming back into the corn market. So if I'm an intermediate term trend, I'm also going to build that into my long term plan. But I just don't have enough. I just don't have enough ammunition, or I just don't see enough on the long-term chart to say I'm going to change my investment position right now, and I'm going to go long corn.
So there's patience on your part. Trend's your friend, right? But where is the confirmation, or what kind of things that you're looking for the confirmation? Let's say, for instance, in this chart. Now this is the corn one, but do you mind if I put up the corn futures contract?
Absolutely, you can go whichever way you'd like.
But in terms of confirmation, is what you're looking for, some kind of confirmational information that'll allow you to say, oh, this trend is over with?
Now, is this the weekly chart, or is this a monthly chart for futures?
Corn. And again, I'll blow this out for, well, let's just do this. Let's play from here.
Okay, there you can see it right there. This is the weekly chart. And if you go 2 bars in from the left, over on the D's corn, you see that 2 weeks ago, December corn on its intermediate, on its weekly chart, so the intermediate term or the secondary trend, actually completed a very simple reversal pattern. It went to a new low and closed higher for the month. I call it a spike reversal. It's not my favorite reversal pattern, but it is a reversal pattern. And so what this tells me is that the money which had been going, funds which had been going short corn, building up a very large net short futures position according to the CFTC commitment to traders report. And again, I look at legacy futures only. They've been building up a large net short futures position. This tells me that, okay, we might have to start expecting, even though it's harvest, even though we've got bushels coming in, these funds could start to cover some of that position. And if they do, it could lead to a secondary uptrend within that long-term downtrend. So that's how I would use that. If I'm still, let's say I'm short corn long-term, and I see this kind of intermediate term trend change, I'm going to either go in with some options on some low volatility here at harvest, protect that position, or maybe just start lifting some of that short corn.
So that kind of leads us to your second rule is, let the market dictate your actions, right?
Correct. Yeah, here, what's interesting here is, I say, and we'll get, as I said, we'll get to it later, fundamentals win in the end, and the first thing I talk about is technicals. That's because, again, it's Newton's first law. It was certainly good enough for me, and funds really do set the trend of the market. But when it does come time to understanding what's going on in the market, we have to look at some filters and let those kind of decide what our strategy should be. How should we approach this market? So we've got our trends, and now we can compare it to seasonality. Well, how does a market normally move this time of year? How about its price distribution? How about what's its volatility? I mentioned volatility in the previous bit with possibly buying calls back against some short option or short futures positions because implied volatility is low. That's one of our filters. So we can use these three filters. We can let the market dictate our act. Excuse me, that's number three. I got ahead of myself there, John. Number two is what are the real fundamentals in the market? I'm not talking about government numbers and these sorts of things, but what are future spreads? What's basis telling us? And since the most common fundamental that we have is future spreads throughout, doesn't matter commodities, whatever we're looking at, whatever sector we're looking at. If we're looking at these spreads and we see that the commercial side of the market's actually bullish, while the non-commercial traders have been selling, that's a divergence that usually is going to wind back up, turning around and going higher. So, in the corn market, we don't see a great deal of carry. It's very neutral right now. In Chicago wheat, say on the other end, it's incredibly bearish. Beans, kind of in that neutral to bearish range. So, we use the future spreads to tell us, what the real fundamentals of the market are. And that then, if I'm short futures and I see a strong carry in the market, I'm going to roll it out because that's telling me it's going to stay bearish for quite some time.
So let's talk about this.
Yeah.
I'm sorry. Let's talk about this chart here because this is really what you're talking about. And I pulled up the December March contract, and you said that would be a good way to kind of look at the carry here. What you were saying is that the market has gone into like this kind of this sideways neutral, maybe an intermediate potential rally, but really what it's about is the volatility is coming out of the market and we're kind of just going sideways. Now, what I see here, this is a daily chart, but if I look at a weekly chart, which is kind of your bread and butter, it looks like, and this is where your expertise comes in, on a weekly basis, this minus 15 cents of this spread, is that kind of in line with what you would look for in terms of the carry?
Yeah, because again, when in the grain sector, what we can do is because we know the cost of storage of the commodity and we know the interest rates, they change every day. So what we can do is, Barchart on its system has a very great cost of carry table. And so when I was a merchandiser a long time ago, I would look at these charts just like what you're showing. We get this flattening out in here in that 14, 15 cent carry range. And so what percent of total commercial carry is that? In the case of corn right now, given where the prices are, given what interest is and all these things, we're looking at about 45, 46%. The table that I built a long time ago to kind of explain this is 67% or more is bearish. I made it very simple. 33% or less is bullish, and everything in between is various degrees of neutral. So again, we've got a very bearish, non-commercial or a fund position with a large net short. We've got neutral fundamentals, and if fundamentals win in the end, again, that could certainly lead to some fund covering here over the coming weeks. So we're going to want to be, we're going to want to be protecting ourselves here a little bit based on what we see in these future spreads based on what we see with real fundamentals. And I have to keep emphasizing that these are the real fundamentals that we're talking about, not the make-believe kind.
Well, I think that leads into your third law, but let's just talk about this chart here for a second. We saw the corn market itself was in a dominant downtrend, both on the monthly and the weekly, and we said that maybe there might be this kind of sideways action. For you to get bullish on the corn market, would you need to see this carry get back up to, let's say, inside minus 10 cents, or even, I don't even know if it's possible. I know that I want to talk about seasonality in a second, but that there's a seasonality in terms of grains market that usually they bottom sometime between now and October. Would that be something that you'd be start looking for in terms of managing risk?
Yeah, I mean, and you're right. That fits in with, with what I jumped ahead of myself there with rule number 3. So, again, we see that net short futures position. We know fundamentals are still neutral and they've stabilized. We can tell that on the charts. So now what is the seasonality? We can look at the seasonality of basis. We can look at the seasonality of spreads. We can look at the seasonality of the futures market itself. And as you said, this is a time of year. It doesn't make any sense, but the markets are what they are. And we do see corn. We do see the corn market start to rally at this time. Flip side of that, crude oil is usually going down this time of year. So, I mean, each market has its own seasonal characteristics, and it has to do with the flow of supply and demand into and out of a market. So, if we know that the fundamentals are flat, neutral in corn, and we know we've got funds have a large net short futures, and seasonally this market's getting ready to turn more bullish. Yeah, we build all of these things in. We build all these filters in. Then we can bring in the low volatility. So options are now affordable. So if we've got a profitable short position, we can either take it off or protect it. So we build these filters in.
So in my world, I'm come from the energy world. We'll look at crude oil in a second, but natural gas, and I know this is one of the markets that you kind of shy away from it, but I think this is a really good chart in terms of what you're talking about, that in terms of managing risk, you need to understand the seasonality, especially when you're talking about commodities. And what I've done here is this is a weekly nearby, again, a weekly chart. And what I've done is the boxes in reds as during the winter season. Now that's called the heating season in the natural gas market. And the green boxes are the summer season, which is called the injection season. There's two different seasons for a natural gas market. So natural gas is one of these markets that has a lot of seasonality to it. But if I ask like a layperson, say, well, what would you think the price of natural gas would do, during the wintertime? Most folks, I think, would say it's going to go higher, right? But you can see here, there's a real risk to seasonality in terms that, in general, natural gas rallies during the summer up until about, end of October into November, and actually during the winter is a time when price tends to fall. So I think this is kind of what you're saying, right?
It is. I mean, you have to understand each market. You have to understand the characteristics, and sometimes it seems counterintuitive. I mean, why, from my layman's view, why would natural gas go down during the winter? Because the locking in of the supplies occurs before they're needed. That's how businesses stay open. That's how they control their prices. They lock them in before they're needed. So this causes the market to go up at a time when you wouldn't expect it to. Plus, it's a global market. There's, as we've certainly seen over the last couple of years, there's a lot of, geopolitical things going on as well, global issues going on as well that can affect, and that can also lead to contra-seasonal moves. And when we see a contra-seasonal move, that's just as important as a market that follows its seasonality, because when you get a contra-seasonal move, it means something has changed fundamentally. We have to go back, look at the spreads. We have to go back and look at, all of the rest of the filters that we have and see if we can spot where things changed and what might happen from here on out.
And I think a classic, another filter that you use is this kind of this price distribution, right, outside of your seasonality, right? You said that we could see a change. Now, you said in crude oil, and I agree with you that you do this kind of this seasonality at the end of the year, but we can see here, this is a weekly chart as well of crude oil, and I've just drawn some what I consider support and resistance levels. But in terms of price distribution, this is how we got to manage our risk. Where, from May of 2020 to, just recently, maybe 2022, we've had this range that's encompasses almost $120, $130, right? So
Yeah.
where are we in this range, or where is
Yeah,
this
see,
distribution?
this is a
Where is the
great
risk to the
example.
market, right?
This is a great example of price distribution. And really what we're looking at is, what's our odds of a market, moving substantially higher against us. But, we can go back, I can't even remember the year, I think it was 2018 or 19, maybe it was 20, when crude oil actually went negative. It did the unthinkable. Crude oil went negative. So we've got a negative 40 sitting down there. And on the high end of that, we've got 130. So everything we thought we knew about a price range in the crude oil market, West Texas Intermediate market, we had to throw out the window and basically start over. Now, as we look at this chart, we can see, where crude oil is right now. It's sold off, it's come down, it's starting to rally again, and it's, just from an eyeball test, it looks like it's still in the upper end of its price distribution range. So I'm not saying it's overpriced right now, because again, if we build in the fundamentals, crude oil has an inverted forward curve. It's had an inverted forward curve for a couple of years now. So we know the fundamentals are bullish. This means that, theoretically, it could continue to go higher. It shouldn't be considered overvalued until we start to see some pressure being put on those spreads and that forward curve.
Well, the old trend is your friend until the potential bend at the end, right?
Right.
But again, how far could crude fall in this price range? Well, maybe we could see crude fall back to the low $80, and it still would be what I would consider still be in an uptrend, right?
Correct.
So
yeah,
the risk,
because
it's that risk reward ratio, right?
again, and there it comes back to, it doesn't matter if folks want to use Dow, they want to use Fibonacci, probably use Fibonacci more now. I don't even know if algorithms use any of that, but you have to expect these Elliott waves. Some people like to look at Elliott, but you get these pullbacks and rallies. It doesn't change the fact that you're still in a long-term, short-term, intermediate-term, whatever time frame you're looking at. The trend stays the same until you get some sort of reversal pattern, or you take out one of those previous lows or highs, and then that changes the game a bit.
Yeah, I mean, let's just do that. I mean, here's our Fibonacci, right? And our 38, our 38% retracement comes right into that old high where we broke out from. So that would, in old school technical analysis, right? That's right. Retest from the impulse, or old resistance becomes new support, right?
Right, exactly.
All right, so let's move on. I think I love this discussion so far. So we've learned about filters. We said seasonality, price distribution, and then this concept of risk, right? Volatility.
Volatility, right.
And this one I think is really a good one too, is that markets that can't go down won't go down. And I guess this is 4B, which is markets that can't go up, won't go up. So in that essence, I want to look at a couple markets that I think would really kind of play this out. So let's look at, now you suggested one that has been just on a tear as of late, and I think that was live cattle, right?
Correct.
And I want to come back with a counterpoint one too as well. But so do you want to look at a monthly chart on this one, or you want to look at a weekly chart?
Yeah, we can look. I mean, the one you have is perfect. I mean, this is the cash index. And again, I like to look at cash indexes as much as possible when I'm talking about long-term investments. It's the intrinsic value of a market. This is what we know a market's really worth. Futures have a lot of things built into them, but the underlying cash value is, again, its intrinsic value. And what we see here is just an incredible uptrend. And as this thing has progressed over the last couple of years, there's been times future spreads have been considerably bearish. I mean, and our other real read on fundamentals, basis has been weak. So all of these things would say, look, funds should stop buying. This market should start to go down, but it doesn't.
It doesn't.
We don't know what the invisible hand is that's holding it up. What continues to push it higher? Maybe it's just packers continuing to buy cash, and U.S. consumers continuing to not be afraid of high-priced box beef and all of these things. But there is a market factor out there. I don't know what I don't know why, but it is. It's just not allowing the market to go down. So everything we look at could say, look, this market needs to go down. We need to position ourselves short. But if it doesn't follow through, if it holds in there and defies all logic, and we can't explain it, and we don't even need to try, we can just simply say, look, it doesn't want to go down. It's not going to go down. We need to continue to follow rule number one. Don't get crossways with the trend. Let's just let it run. We'll try to figure it out later.
Objects that are in motion stay in motion.
Exactly.
Is there ever a point, let's say for instance, in this market, and I'm sure there's a couple of the softs we could talk about, orange juice in particular is the one that stands out of mind. Is there ever a point where you say, hey, you know what? Maybe if I'm not in this market, or that this volatility, this run is just too hot, it's too much for me, and to me there's just too much risk. Do you ever stay out of a market like this?
Every day with natural gas, and I say that jokingly, John, because I know you're a natural gas trader at heart. But yes, back in the day it was pork bellies. I knew some folks who like to trade pork bellies. It just never was anything that I could get comfortable with, and that's a big part of it. You in the title you called psychological. Psychology of markets has changed a great deal with the influx of algorithm trade and so on. But it also comes down to the trader. I mean, if you just don't have a feel for a market, if it just continues to beat you and you just can't get a good read on it, yes, I stay out. Natural gas is certainly that way. Other markets that I would think of,
teach you a little bit about natural gas, so not to be afraid of it.
Yeah, other things I would look at, this cattle market, I would, if I haven't been along, if I don't own the actual cash cattle, I'd probably stay out of it at this point. We've also seen it in the softs with lumber and cocoa and sugar and all of these things handing the baton off one after the other. Now it's firmly in the hands of orange juice, where they're just screaming higher. There are some fundamental reasons for what the softs markets have been doing, but it's not something I'd want to jump into right now.
So for me, I think one of the things like lumber, you mentioned lumber and you mentioned orange juice, and even I think cattle, I've traded all futures contracts and I've dabbled in some of those ones, but for me, it's always about volume and open interest, right? Is there a kind of threshold that you look at for, let's say, in the futures markets on some of these less liquid markets?
Yeah, each sector has those markets that's heavily traded. So if we look at the livestock, we know that live cattle's got the heaviest open interest, highest trade volume. Then it comes down to lean hogs, and feeder cattle is pretty thin, and so that can be kind of a spooky situation, and it can lead to some erratic behavior as well. If we're looking at the wheat sector, obviously Chicago's the third largest crop that the U.S. grows, but yet it's the largest traded wheat market in the world, wheat futures market in the world. So, you obviously, if you want to trade wheat, most folks jump over into Chicago. Kansas City's pretty good, but then you have to be careful with Minneapolis. There's not very many traders. There's not many orders. Open interest is pretty small. So, yeah, and I go back to the days on the floor, some of the horror stories I would always hear about the oat pit. They're legendary.
Right.
In the grain world, there was a handful of traders, and they were all run, by these sharks who were in the pit just waiting for people, out in the country, folks my customers and everyone else who would come wandering in like a young calf into a stream filled with piranha, and it was over before it even began. And so you have to be careful with those thin markets.
Yeah, when I first started at NYMEX, we still had potatoes, and we used to call that the Roach Motel market, because you could get into the market, but you couldn't get out, right?
Could never get out.
Right. So rule number 5, and this one I love, because I think that when we talk about retail traders or novice traders, and I don't like using that word because I think it's kind of derogatory. I call them junior traders because they just have less experience. But they're consumed by the why, right? Why did the market go up? Why did the market do this, right? And your rule is don't worry about the why, just the what. Just look at what the market is. And I think this goes back to your was it rule number 2 is like, don't tell the market what to do, right? Let the market tell you what it's going to do. So it's more this what. And so this is where I'm going to challenge you.
Yeah.
Here's the TLT. And I think, there's been a lot of discussion about, is it the Fed? Is it about increased supply of treasuries? Or is it about the strength of the dollar? Blah, blah, blah. All this stuff, all this why. But to me, it's the what. And the what here is that we just continue to see bond prices go down, right?
That's right. And that's the bottom line. I mean, it doesn't matter what media you look at. You can look at regular media, you can look at social media, you can look at the, the X site formerly known as Twitter. You can look anywhere, and every day, there's thousands of people out there telling you why a market did something, and 99.9% of them don't know. The 0.1% who do know, they're not going to say. So there's no reason really to make up reasons why. Why are bonds collapsing? Because yields just continue to scream higher. We can, as you mentioned, there's a long list of reasons that we could start to tack onto this. But the bottom line is this market's trending down. It's fundamentally bearish. It's got all of these things going on. It's just a bearish market right now, and that is the what we can see who's selling, and right now that's everybody. One of the tests that I used to do. Or one of the things that I used to do when I would give presentations on these market rules is I would just pull up a random slide, a quote screen, and we would see, let's say it's cotton, and we could see, how 6 to 8 of the contracts closed that day. And I would just say, okay, what happened? And we could tell by the way, future spreads were, what the volume was, how the size of the changes in the market. You can say, look, this looked like some fun buying with some support coming from the commercial side, or commercials were putting a cap on the rally. That's all we need to know: who was buying, who was selling. All the reasons why will wash out in the end, and most of them are made up anyway.
Well, I come from more of a technical view of right. And I do believe in fundamentals, and I think if we weighed the two of them together, we both agree the fundamentals, and that's going to come to our next rule. But one of the tenets of technical analysis is that price discounts everything, right? Right. So everything that is known is already in the market. So that's why you don't need to know the why, right? You just let the market tell you what it's going to do. What I like about this chart, though, it does bring me to another adage, and I'm sure you're familiar with this one, right? Is bulls take the stairs and bears take the elevator, and you can really see that in this example.
You certainly can. A gentleman sent in a question earlier today. He wasn't going to be able to participate here this afternoon, and he said, it took 13 years for the market to rally and 3 years for it to fall. And that's exactly right. Again, when a market moves higher, it's fighting all of these things. It's fighting all these things. People are wanting to sell and this and that and everything else. So it does take the stairs up. And then when it starts to break and everybody decides to get out at the same time, it takes the escalator down. Now we have to put an asterisk, like everything when it comes to analysis, to that. Again, let's look back at the softs. We are seeing rocket rides going higher in nearly every market. I mean, they're just going parabolic. And right now, the ball's in orange juice's court. And the pun out there is it's a squeeze going on in the orange juice market. But seriously, it is. I mean, you've got a sharply inverted forward curve. You've got future spreads just showing incredible inverse. And there's just no stopping this market. And I know as soon as I say that, it'll probably be limit down for the next 10 days. I don't know, but it certainly could, because it's a weather derivative. And if the weather changes or the fundamentals change, this thing is going to come back down. But I'm not going to be the first one to step in front of it.
But I think on this chart in particular, let's go back to your rule about filters and talk about price distribution, right, on a historical basis, right? Sure. We can see what has happened, over the last 10 years. But, here's a 30-year bond futures contract, and now I'm showing over the last 20 years. And, let's really shrink this chart up, right? I mean, we're going back to like 1980. In terms of a historical price perspective, we've had low interest rates for a long period of time. But if we think about a mean reversion, right, and the par value of a 30-year bond, I believe, is 6%, right? So somebody might ask you, well, where could interest rates go? Well, in a historical long-term price distribution, we could go back to par, which is 100, which would be around 6%. Do you agree with that kind of process?
Yeah, sure. And I do. And what you just did here is a good explanation as to why sometimes price distribution isn't all that reliable. Because when you had it, when you were looking at a little narrower view, say a 10 to 15 year view, okay, so we're down near the lowest end. We're at 16-year lows. Okay, so if we're looking at a 15 to 20 year view, traders are going to say, okay, based on price distribution, this looks like it's an undervalued market, so we can step in. But You widen it out to 30, and these are 30-year bonds that we're talking about, and all of a sudden you see maybe we're about mid-range. We could go back to par. There's still the possibility of some pressure, some selling in this market. The trend hasn't changed, so that's why distribution is a filter, and it's a filter that is heavily reliant on, okay, what is the time frame that we're studying? What do we feel like the most relevant time frame is for our position? And if we're talking about long-term bonds, we may have to go out to a longer-term time frame, which changes our perspective completely.
Yeah, and the other thing I picked up on this when I was doing this chart was the purple line here represents our open interest in this futures contract, and you can see that there's a lot of people that this might be becoming a crowded trade because we have a large amount of open interest. Now, what I found interesting is a lot of these peaks did come where we had rallies in the bond market, right? You can see a peak here as well. This is really the first time we're really kind of seeing this rise in open interest as our contract has been falling. So I don't know, maybe there's something
that
else.
brings up another thing that I talk about occasionally, John. I call it the Poseidon predicament. And it's a great point. I mean, you're seeing this open interest just skyrocketing higher, and it's all going to the short side. So, you and I have been around a long time, 35, 40 years. And so when everybody rushes over to the same side of the boat, at least historically, when it was folks in the market, not just algorithms in the market, when everybody ran over to the same side of the boat, you're absolutely right. It flipped over.
Yeah.
And so, we would look for that. That was part of the psychology of the market. It's changed, but we can still look for that, and that's an incredible study that you tacked on there. That increase in open interest to go along with this downtrend. Yes, another one of the basic tenets of technical analysis is when trade volume and open interest is going up on a downtrend, that's bearish. But you can also hit that tipping point that when you get too overloaded to one side, kind of like what I was talking about with corn, this large fund short position, and the fundamentals don't support it anymore. That's when the boat rolls over.
All right, so let's move on to your next rule, and I think this kind of ties back to what we just talked about, and that is fundamentals win in the end. Now, in my world on the floor, we used to say that on a daily basis, technicals can win the battles, but in the long run, fundamentals always win the war. So I totally agree with this rule. So let's shift a little bit away from commodities, right? Because that's more about real supply and real demand. Let's talk about your philosophy as it relates to, let's say, the equities market. Now, I know we've had this discussion, you and I, and my opinion is that, in the long run, what makes stock prices go up is as long as the company is continuing to do well or have good earnings or earnings growth, then that will be reflected in your stock. But you kind of look at it from a different perspective, right?
Yeah, I'm not a big earnings analyst or price to earnings and these sorts of things. I think they're outdated. If we say that traders, investors, excuse me, when we're talking about equities, if we're talking about investors only basing their investments on historics. So in other words, it breaks the rule of that we all know by heart. Anyone who's been in this business, past performance is not indicative of future profit and loss. So what you're saying, what the argument is, investors don't know anything about the company they're investing in until they get previous earnings statements coming out. And I don't agree with that. I think they have an idea. I think they do their own research. I think they have an understanding of the strength or weakness of the market. Warren Buffett always talks about it. Is a market overbought? Is it oversold? Is it underpriced, overpriced? These sorts of things. And that's what you look for. It's on its future possibility, not on its past earnings. And so, this is where the fundamentals come into play. What is the overall trend of the sector? We can go back 10 years to where Tesla was a penny stock or whatever it was. What was the future of electronic vehicles at that point? I know there were some very young analysts in the industry who were really touting this, saying, look, this is the next wave. This is looking ahead. It's not looking back at Tesla's former quarter's earnings. There wasn't any, but they're looking ahead at what the industry is going to do, and that's where fundamentals get tricky particularly in equities, because it's a kind of a vague term, equities fundamentals, but you have to look at the sectors. You have to look at, what's going to be driving these markets, and we see the different indexes changing over time. Right now, the Dow Jones isn't as strong as the others because it's all moving forward.
So if those fund earnings are not a part of your process in terms of, let's say, investing in the equities market, are you more of a momentum or this sector rotation kind of trader?
I would say it's probably more on the sector rotation, or you're looking for growth, you're looking for value. Momentum's a tricky thing, and it doesn't matter what sector we look at. It could be financials, it could be equities, it could be treasuries, but because it's a lagging indicator. Certainly it's useful, but yes. So I look at momentum, but I think the biggest thing is you have to try to find those sectors. You have to do the homework on what sectors are showing the possibility of solid growth. And if you find a growth sector, and then you can start to find some companies or some stocks that could be undervalued within that sector based on what they're looking at doing, what they're looking at producing, then all of a sudden you can roll the dice and say, okay, this looks like it's going to be something that could be profitable 10, 15, 20 years down the road.
So we're in the same boat in this. This is kind of how I would do. I look for like the outperforming sectors, and then I'd go inside that sector, and then where I'm more like a momentum trader, I'd rather look at those stocks that are in that sector that are growing or are performing well compared to their peers, and also the S&P. Now I thought this was an interesting. This is one of our charts in our performance sector. This is all the S&P sectors, and we know the AI story, right? That's really what's driven the market since the beginning of the year. But I thought you might laugh at this one. Again, if I go back to, January of 2020? Yeah, 2022, which was the top of the S&P market, right? I think that's what it was. It's kind of unusual. Well, not unusual, but the fact is that, again, I think this is what you're saying, is that, you need to be very cautious about a lot of the different sectors and how they grow. The energy sector is the only one that has a positive return over the last 2 years, where all the other ones have a negative return. And then if you ask somebody that, I think that would really surprise people. So the question now is, is this the sector that we want to look at, or are we going to look at, again, that momentum story?
Yeah.
Right? Which is, that AI or mega.
Your point about momentum is well taken, because again, it goes back to rule number one: don't get crossways with the trend. And so if we're seeing, the momentum building on these, and you're seeing some larger investment groups going into this market, there's a reason. Again, they're doing their own research. It's not all based on former or past quarterly earnings. Because again, let's go back to January 2022, whatever time frame that was. If we're looking at the Octave D's for 21, I mean, the earnings would have been outstanding. So everyone's buying in, and then the market collapses. I mean, so that's what simply following earnings and not following momentum, not following growth. I mean, that's what it can do to you. I used to always call, it's hard to drive down the interstate using only your rear view mirror. And it's that way if you're just simply using earnings reports.
What about money flow in terms of equities markets? Do you believe in that?
I think there is some value, because again, it's showing where the investors are going in. Now, just as with any market, they can hide it. They can do a lot of different things, a lot of different types of positioning with options. Well, a lot of folks don't understand when they start talking about CFTC reports over in the commodities again, those option traders, everyone wants to talk about the CFTC reports that include options, but option traders are doing it for a lot of different reasons. And they can do the same thing in equity. So, I mean, yes, generally you can look at the money flow, because again, it comes into, is this supporting this, is this supporting the trend? Is it not supporting the trend? We're seeing a bubble develop, like all of these meme stocks a couple of years ago, where was the money flow? It was very short term. It wasn't going to last. We could see that. So yes, I think money flow is important, but it has to go along with many of these other indicators that we're looking for. So
money chases return, kind of like money flows in, and I think this will lead to your next point. But here's like a S&P, the SPY, And one of my hard rules in terms of investing, and I get again, I think we're coming from this different angles, but we're saying basically the same thing. I might day trade or swing trade a wide range of equities, but one of my hard fast rules is I will only invest or put into my investment bucket any stock that has to be above the 200-day moving average, because to me that is telling me that price above 200-day moving average in the long run is this is a company that is performing well and the market is rewarding it because it's trending above this longer period of time. Again, going back to your big picture market analysis.
Yeah, you're right. I mean, that brings so many things into account. It's bringing trend into account. It's bringing momentum into account. It's bringing money flow into account. And so so you sit back and you say, yeah, I mean, if you use the 20-day, use the 100-day, whatever moving average folks like to use in equities, if you're looking at long-term investments, certainly you want to give yourself some time and some space. You don't want to miss out on it, but you also want to get in too early. So yeah, I mean, it does encompass all of those things we've talked about, and it certainly fits with the idea that you're just letting the market confirm itself or a stock confirm itself that its fundamentals have changed and the investment structure of the stock itself has changed.
Let the market dictate your actions, right?
Exactly.
All right, so your final rule. All right, the stock market goes up over time. Now, you started off in the discussion about how you got into business back in, was your first day Black Monday in 1997? No.
That was my first realization that it was going to be interesting trying to figure out markets. I grew up around the grain industry, working in elevators and so on. So I was always talking about commodities, but it was Black Monday 1987 that really kind of shook me and changed the course of my career. And said, okay, it's going to be interesting trying to figure out what happens, not why things happen, but what happens, what causes these things to happen, what causes things like Black Monday, because there was 10,000 reasons why. And so, yes, it goes back to that. But that's kind of my starting point. We can go back further. We can go back to the 20s. We can go back to the 30s. We can go back as far as we want. But what you see, if you plot this out, simple price direction over time, and stock markets have gone up. And it's because investment money is continually, usually, I mean, there are things like depressions and so on that stop the flow of money, but money tends to flow into these long-term stock investments. Now, it's not always the Dow Jones Industrial, it's not always the S&P or the NASDAQ or the Russell or whatever it might be. But in general, these markets are going to go up. They're going to continue to generate money. Some of that money is going to work out to other investment sectors. Maybe it's commodities, maybe it's treasuries, maybe it's something else where you pull some money out of equities. But the bottom line, the backstop to all of this is that you can put money in stock markets, in the equities, and over time, you give it enough time, it's going to go up. It's going to generate other money.
Again, this idea that money, it consistently looks for returns. Maybe we can think of it more like a bathtub, right? Money flows into the stock market, and then when the bathtub gets full, when the market gets frothy, right, there's less returns, then money distributes into commodities or treasuries or whatever, but then the bathtub drains again, and then money is still, that bathtub is still getting full with water every day, right, through
I love that analogy. That's a great analogy.
All right. Well, let's see where we're at. Well, I think we're right in time. Let's see if we have any questions. Gene, any questions popping through here yet?
Nothing specific that I can pass through at this moment.
Okay.
I do want you to go back to Darin's author page. So if people are interested in following what Darin says, and he publishes articles all the time, it's right there in our news section, and you can follow Darin and get his updates right to your inbox every single day.
And I follow Darin. I enjoy his articles. I enjoy his wit. I love his references. A lot of his rules. He has a reference to one of his favorite movies. I can't remember which one was in this article. Was it a Star Wars reference? No, I don't know.
Oh, I think it probably was. Yeah.
So I love your references. All right, so I have a
Appreciate
question
that.
for you. So, looking out, we've been around a long time, right? And the way that we digest markets, or the way we now analyze markets, has changed dramatically in the last 3-4 decades. So where do you see the change in the direction of markets, and also maybe technical analysis?
Yeah, technical analysis is difficult, because as I mentioned earlier, I think we can go back to the early 2000s when the algorithms and the computer trade basically started taking over the markets. And it changed, again, it changed the psychology. It changed how these markets traded. Back when it was pit traders, when it was floor traders, when, it was these sorts of things, you could kind of pick up on the human psychology of things. Everyone, if they were technical analysis, they were basically looking at the same set of charts. So they were looking at the same breakout points and breakdown points and, the moving averages and these kinds of things.
Self-fulfilling prophecy kind of thing, right?
Absolutely, and then that was always the knock against technical analysis, is it was self-fulfilling prophecy, because basically everybody was looking at something similar. But now we've got the algorithms, and the coders and the writers that I've talked to, they're all looking at something different. They're all building different things. You mentioned the 200-day. Some of them are using the 200-day. Some of them are using crosses. Some of them are using, other momentum indicators. Some of them are using volatility. As a director, they're using these filters, but still kind of keeping an eye on trend. And then when they look for reversals, they're looking for different things. What's the money flow doing? All of these different kinds of things. So it is changing, and it has changed dramatically over the last 15, 20 years. And I think that's going to continue, because I think we're going to just continue to see that side of the market evolve. It's going to be less human and more computer. We're going to see more meme stocks. We're going to see, often we're going to see the commoditization of equities, which goes back again 20 years to a conversation I had with a gentleman back then. Sometimes it's not going to be an investment vehicle, because it's just not going to make any sense. So we're going to have to bring rules 4A and 4B into play. Markets can't go down, won't go up, can't go up. Because we're going to see more of this sort of thing happening, things that just defy logic and really just kind of break the rules of what we understand technical analysis to be.
I think a great example that would be very timely is the fact that if we look at the S&P and we look at those stocks are doing well and those stocks that aren't doing well, I think I saw some statistic that the Magnificent Seven, right? I guess I'm going to add the Qs in here as well, is that they represent something like 27% of the capitalization of those markets, but they represent something like 50% of the returns of the markets. And so, that wealth concentration that's in these 7 stocks, 7 years ago or 10 years ago or 30 years ago, we would have said that might be something that is dangerous, right? Again, that Poseidon, right? Everything's into one boat. But maybe this is the new dynamic, right? That
it is. It certainly breaks all the rules that you and I talked about. I mean, again, everyone's on the same side of the boat. All the eggs are in one basket. There's no diversification in these, in these investments at all. It's all loaded into these. Okay, so why is that? So this goes back to value. This goes back to growth. So much of the rest of the industry just simply hasn't caught up. So these 7 major, the Magnificent Seven, that's where all the interest is. That's where the investment money is going. That's the money flow. So yeah, it's fascinating, because our training tells us it's a very dangerous situation, and it certainly could be. But as we've watched these markets evolve, and we've seen this happen more and more, and get more concentrated in just this small basket of stocks and equities, it could be just the way things are. It's just going to be the way things are for a while. And it doesn't necessarily mean we're going to crash the markets, but it does mean that if one of those has a hiccup, if there's a major problem, like Apple has something going on over in China, or Tesla has a problem, or whatever it might be, it can cause a major swing. And we can see wilder, more volatility and wilder swings along the way.
A lot much larger single stock
Yes.
event or single stock exposure. So I agree with you on that. All right, so I see a couple of questions here. You want to answer a couple of questions in a little bit of time we have left?
Certainly.
So please explain the theory that a lot of people are saying about the bond market is telling that commodity markets are going to become very bearish. Why?
The bond, with bonds going down, that would indicate that the U.S. dollar is going to continue to strengthen. And historically, when you've got the dollar strengthening, that tends to be viewed as bearish for commodities. I don't necessarily hold to that. Yes, I know that's the theory, but it's still, these commodities are driven by supply and demand, and so many of them are still in very tight supply and demand situations. And what we have to take into account, probably more so than we ever did, is the political situation, is the global situation. Russia invading Ukraine. We've got interest rates going up around the world. We've got these things. We've got countries looking for a steady or sturdy, or I should say reliable currency to bank on. So, I don't put as much stock in the idea that just because the U.S. dollar is trending higher, that it's going to automatically mean the commodities are going to crash. Again, we've got sharply inverted forward curves in the energies. We've got some bullish spreads going on in certainly in some of the soft markets, and so it's actually going to take a change in fundamentals. And with so many of these being weather derivatives, that means we're going to have to see a change in the weather. It could certainly cause a hiccup. It could certainly cause some of the investment money to move away. But as John and I were talking about, when it comes down to it, investors are going to be looking for those markets with bullish fundamentals, and they're not really going to care about what the value of the dollar is. That's not going to be their main deciding factor.
Right. Look here. I put it. Here's crude oil. This is a daily chart, but and the blue line here is the dollar, right? And you can see that since crude oil started around, so has the dollar. So that kind of blows this theory. Like what you're saying is that maybe the dollar, yes, and maybe in the long run it does have an effect, but on a day-to-day basis, right? Technicals, right? There's a change in the dynamics of what is going on. And I'm sure if we did this with grains, we might get, maybe a little bit of a different picture. But still, right? It's not about the dollar. It's really about what the dollar is doing by itself and what crude oil is.
Right. Every market has its own fundamentals, and these markets are interconnected. I'm not saying that they're not. They are, but it's not absolutely dependent. One is not absolutely dependent on the other.
Right. Okay. So a question here says, does social sentiment come into play with either John or Darin's stock investment? So I think we kind of answered that price is really a reflection of all known knowledge, and also I think there's a component of sentiment in that. So as long as the market is money flow is in sentiment, positive sentiment, then if I'm investing in a momentum stock, then I would say that the sentiment is. I do believe that there are inflection points in the equities markets, let's say when the VIX gets elevated or when it gets really low, or like we talk about in futures markets where everybody loads the boat and open interest gets really high, that these inflection points can create trend reversals or price reversals. So I do believe it's part of my process. I don't know. What about yours?
Yeah, I guess when the question asks about some of the social sentiment, I get back to thinking, what is the good these stocks, the companies of these stocks are trying to do in the world. And to me, we don't have enough track record on this yet. This would look to be short-term sentiment, and we're talking about long-term investments. So I mean, if you continue to see money flow coming into it and momentum building, then okay, kind of like Tesla, then you can start to, it does influence your investment decisions. But I'm not going, when I'm looking at all of these social stocks and so on, I'm not going to be swept away by each and every the flavor of the day. It's got to prove a track record. It's the rest of the sector has to say, look, there is something here. There is something here that should continue to grow.
Right. I just, for just giggles here, put up the dollar versus the S&P. So there is some inverse reaction, and there's also some positive correlation as well. All right, buddy. Let's see. We're at the top of the hour. I want to thank you so much. I can't tell you how happy I was. I hope that you enjoyed yourself, and maybe we'll have you back sometime in the future.
Yeah, I really enjoyed it, John. It was a great discussion, and I really appreciate you having me on.
Folks, again, as Gene pointed out, if you don't know where you can find Darin, he's under our news section. Here's our feature artists, and what do you write about? An article, what, 2 articles a week? Or
2 to 3 articles a week, yep, depending on what's happening.
Whatever tickles your fancy, so to speak.
Exactly.
All right, my friend. Well, you, as I say to all my friends, be safe, be healthy, and the best of all, trading to you, my friend, okay?
Much appreciated, John.
I just want to remind folks that next week for our upcoming webinars, we're going to do a session on head and shoulders. This is a real powerful trend reversal pattern, and we're going to talk about this from a very technical aspect. In other words, like kind of these base rules. Now, there's a lot of market activity just recently, especially in some of these indexes that are creating these head and shoulders. And one of the ones that we identified in another show that we do on Fridays, our Market on Close show, is this head and shoulder. And this is the IWM, and you can see a nice head and shoulders here, and we've broken this neckline. And so if one of the cool things about head and shoulders movements is you can extrapolate from the neckline break to the head and measure a move. And you can see on this case, there's still a lot of room technically for the Russell to go lower. So trend's your friend, and now we have some technical evidence to back that up. So come and join us for that show. I think you'll enjoy that show. And again, for all of our Premier and Plus members, we have our show on Fridays, Market on Close. And boy, this has been a really interesting week. So I'm sure a lot of the subject matters we're going to discuss on that one will be very timely and topical. Gene, thanks again. Welcome back. I'm glad you're back. I think we had a good session today. Until next time, folks, be safe, the best of health,